This is a Momentum Media production.
The SMSF Advisor Show. Your expert insights into the biggest themes shaping the SMSF advice industry.
Hi everyone, and welcome to the SMSF Advisor Show. I'm joined by my co-host Aaron Dunn, CEO of Smarter SMSF. Hi Aaron.
Hi Miranda, how are you?
I'm good, and how are you?
Not too bad. I'm a lot drier down in Melbourne than up in New South Wales and obviously parts of Queensland. So I did first face-to-face events last week. So BGL had their RegTech event in Sydney and was meant to be Brisbane, but unfortunately got cancelled due to the inclement weather. So it was just nice to be out amongst people again at events. So even though I only got one of two, yeah, it was just nice. So hopefully, that's going to become a more normal part of our life again, getting out, going to events, presenting at events, attending events as an attendee, things like the SMSF National Conference coming up, of course, as well. Yeah, so that was nice.
Yeah, it does seem like that's all taking back off again, which is great. Yeah.
Yeah. So as is always the case, we start off our SMSF Advisor Show looking at what is making news. So Miranda, fill us in.
So probably the biggest story that's sort of come out over the last fortnight is that the government has now tabled those regulations for the repeal of the work test. So that was kind of the second part that needed to be done. They had the bill that passed through, but this was the second part to that where they actually made the regulations to introduce that.
Yeah, so you talked about the past fortnight. This has really landed in the past few days, hasn't it, if we think about it? So, and you rightly said this has been the other side of the jigsaw puzzle that we've been waiting for. So the bill, obviously, that had been passed around the budget measures, which included that ability to remove the work test for voluntary contributions, really only looked at the elements of what I called the eligibility and the opportunity for bring forward. So things that sat inside the Income Tax Assessment Act. So all things, when we look at contributions, we have eligibility, but we also have acceptance, and those acceptance rules sat within the SIS regulations. So these were registered, as you said, and we now have that certainty on both sides of the coin here that simplify in quite a large amount of detail that whole acceptance of contributions. So in essence, a member contribution is just ordinarily accepted from a regulations point of view, but we do need to look at the work test only in the context of claiming a tax deduction going forward, where that individual is 67 through to age 75. So we have a much cleaner set of SIS regulations now that deal with the acceptance of contributions, which is great.
Yeah, certainly make things a bit simpler, and perhaps there'll be some more sort of strategy stuff that can be done with clients as well around that.
Yeah, and they've done it very neatly as well when you include the downsides of contributions as well. So you've kind of got your, under 60 years of age, 60 through to, I can't remember what it is now off the top of my head, but yeah, so there's a nice sort of neat schedule that now sits within 7041 there, looking at really three distinct age groups. So 75 and over, I think it's 60 to 75 and then under 60 years of age. So yeah, it's a good result.
We've also seen ASIC release some consultation on the Financial Services and Credit Panel, which looks after the conduct of financial advisors. And it's just put out some draft guidance on basically how it will assess advisors as a fit and proper person, and when it will use the panel to assess misconduct and a few things along those lines.
Yeah, so again, this is all focusing on where we're heading as an industry with advice. And I know the SMSF Association has certainly been sort of front and centre here with the way in which they're advocating for how that advice would run. And we're seeing, we're in the midst of submissions on a whole range of things. If we overlay the Quality of Advice Review, we've seen the federal budget, which is only a few weeks away as well. So there's an opportunity here to really be providing a lot of input into where we want the industry obviously to be heading. And the this interim report obviously is just one part to that much larger jigsaw that we have, that we're working through at the moment to try and improve what advice might look like as we move into this year and thereafter.
Yeah, and another sort of one of those reviews that relates to that whole area is the Australian Law Reform Commission's review of financial services legislation. And the SMSF Association has put in a submission into that, sort of stressing the point that the advice terms that exist at the moment are pretty confusing for consumers. So perhaps that could be looked at so that, I guess, it better reflects the diversity of the sector and the different kinds of professionals and types of advice that can be provided.
Yeah, and that's we had this fantastic SMSF advisor show a month or so ago with not only the SMSF Association, but the major accounting bodies. And we spoke about the fact that we need to try and fix the way that the advice construct is set up and really trying to identify the terminology that would be most suitable to the consumer, and the fact that not only is advice consumer centric, but the fact that there is arguably a delineation between what is strategic based advice through to more financial product advice, and the potential disconnect that we need across those two things. So again, an opportunity here to be reviewing that activity and again, getting in front of the government to try and come up with what we see as an opportunity as an industry to be professional, driven by the profession as opposed to driven through the regulators.
The other sort of advocacy area we've seen is to do with the Inspector General of Taxation and Taxation Ombudsman review of Commissioner remedial powers. And there's sort of been some advocacy saying that it could be a bit more transparent, the process, especially when the Commissioner decides not to exercise remedial powers. And the SMSF Association highlighted perhaps some legacy issues where those powers could be used to reduce problems for people being impacted by legislation was really not intended for it to act that way.
Yeah, so this is something that really got highlighted with the market-linked pension discrepancy that we saw with the introduction of the super reform. So the fact that commutations of cap defined benefit income streams that were market-linked pensions ultimately had a zero value, and then there was a consultative process to try and get that legislation fixed, and there was no instrument that was taken by the Commissioner that we could have had ultimately here, that in this instance has kind of highlighted the fact that there was a lack of transparency here for the provision of getting certainty in how we could advise people. And ultimately it was left and waited for some period of time. You know, we've only seen this sort of transpire late last year. So there's a hell of a lot of time that has gone past before we've actually got a resolution on it. And then the whole industry is trying to backpedal because it goes back to an effective date of 1 July 2017. So the real issue that the SMSF Association is taking up to task here is to go, well, how can we be more transparent on when a matter is referred for consideration under the Commissioner's remedial powers in that case? And, you know, I think it's a fairly strong argument to be asking for, in particular where there is some time sensitivity on that sort of stuff. If we think about the impact for transfer balance account reporting in particular, I know that the ATO gave some CRT alerts to help work through that, but there's clearly a better way that we can come up with solutions here, and the powers in this instance could have potentially given us a much more palatable outcome as we work through those issues over the past few years.
We've also seen ASIC have a bit of a crackdown on reciprocal audit arrangements and concerns around auditor independence. And there's been voluntary cancellations of registrations accepted for 9 auditors, and it also imposed conditions on the registration of a further 9 auditors as well.
Yeah, so the ATO has been pretty clear on this since the introduction of the APES 110 requirement. So it was noted for some time. The ATO went through a very clear education process with auditors and made it quite clear what would be acceptable from an arrangements point of view to meet those independence requirements. And that once 1 July 2021 came around, education was moving into enforcement. So those that, have been caught in this sort of scenario have had, in the ATO's eyes, and I think many in the profession, there was some argument to say maybe we needed some extension of time beyond that. But ultimately, the ATO has given a drop dead date. Those that have tried, or those that have complied, have gone away and done what they needed to do, and others have tried to, in this instance, potentially short circuit the way in which those arrangements would be met, and ultimately have come up short through the ATO process when they've looked at the returns and obviously been able to cross-match different firms, and therefore recognising that there's not a level of compliance with what APES 110 requires them to do.
Yeah, certainly a good reminder about those independence changes and the need to make sure that what you're doing is in line with that guidance.
Yep, absolutely.
So we're now going to be joined by Rebecca Oakes, SMSF Technical Manager from Act2 Solutions. She's going to be taking us through some of those recent ECPI changes that will be happening for this income year onwards. Hi, Beck.
Hi, Miranda. Thanks for having me.
Thanks for joining us. So there have been two important changes affecting ECPI for the 21-22 financial year. Can you give us a brief outline of those items?
Yeah, sure. So the first change we saw was in relation to disregarded small fund assets under Section 295-387 of the Income Tax Assessment Act. Essentially what this amendment is that where you've got a fund which is entirely in retirement phase for the full financial year, that it cannot have disregarded small fund assets, and it will have to use the segregated method when claiming ECPI. The reason for this change is there was a bit of a glitch in the old law where essentially if you had a fund that was entirely in retirement phase and there was a member in the fund that had a total super balance of more than 1.6 million just prior to the start of the financial year, that fund would meet the criteria of having disregarded small fund assets, and it would not be eligible to use the segregated method, and it would have to use the unsegregated method when claiming ECPI. Now, the issue with that is that funds were having to get an actuarial certificate saying 100% tax exempt, which is obviously a bit of a redundant requirement. So the government have fixed that up by amending the disregarded small fund assets legislation.
So, Beck, it only took them about 4 and a bit years to get that sorted. So it's been a bugbear of mine since that legislation came in. It was very obvious when they introduced it. I called it policy on the run, because what they did is they said, well, look, we don't want assets moving from a retirement phase into accumulation phase to try and avoid CGT issues and so forth. So they kind of introduced this concept of disregarded small fund assets, right? And the thing that really bugs me even more is the fact that we actually have a hardwired number of $1.6 million as well with that, whereby everything else is linked to a general transfer balance cap, which has naturally moved. So I'm glad that we've fixed it, but I think there's probably a bit more that we could do to fix it as well.
Yeah, you're exactly right. Yeah. And then the other change that we saw was in relation to Section 295-385 of the Income Tax Assessment Act. And this talks about when trustees can use segregated current pension assets. And essentially, I think the best way to get your head around what this amendment is probably first if I just clarify what the old law stated. So essentially what the old law used to say is that from 1 July 2017, if you had a fund that was eligible to use the segregated method and there were periods during the financial year solely supporting retirement phase, those periods were deemed segregated. So the fund had to use the segregated method for those periods. And then those periods outside of the full retirement phase periods would be unsegregated. Now, the issue with this is that some funds were going into full retirement phase, then back out of full retirement phase, and it would create multiple deemed segregated periods, which left the trustees and the fund administrators with the tricky task of trying to identify all the income received in the deemed segregated periods and then identify all the income received in the unsegregated periods to calculate exempt current pension income. We would even see some trustees just leave $1 in accumulation to try and avoid this complex and costly task. So what the government have done to fix this issue is that they're saying now from 1 July 2021, where you've got a fund that is eligible to use the segregated method, and there are periods during the financial year solely supporting retirement phase, the trustees can choose to keep those deemed segregated periods, or they can choose to treat the fund as unsegregated for the entire financial year. Now, it's probably important to highlight that you don't get to pick and choose which full retirement phase periods are segregated and which ones are unsegregated. You've either got two choices. You keep all deemed segregated periods, or you just use the unsegregated method for the entire financial year.
So, Beck, there's a bit of the change, I think, that happened with those ECPI measures from the 1st of July 2017, and I guess he's coming back in here as well with these choice methodology, is that income was looked at when it was earned, whereas under the current rules, it's kind of looked at when it's received. So, and I think, you can maybe talk to this by way of example now as well, but this concept of choice is, whilst it's not going to impact a large number of funds, it is an important concept to get your head around, because strategically, and we'll talk about some of the strategic opportunities a little bit later, but strategically, there are things that you need to be very cognizant of here to get the best possible outcome for your client by making that choice, or just simply going under the current default approach.
Yes, yeah, you're completely right. Yeah, so timing of income definitely plays a key role in deciding which option to go with, that's for sure.
Yep. So maybe give us a bit of an example to give us some context, I guess, as to what this law change means.
Yeah, sure. So consider that you've got a one-member fund, right? And at the start of the financial year, so the start of the 2022 financial year, that member has got $400,000 in accumulation and $500,000 in retirement phase. And let's say that on the 1st of January, that member moves all their accumulation money into retirement phase. So what we have here is two periods. We've got from 1 July to the 31st of December, there's a mix of retirement phase and accumulation. And then from 1 January to 30 June, the fund's fully in retirement phase. Now, if we say that this fund's eligible to use the segregated method, then the trustees of this fund will have a choice. The option one is that they can keep the deemed segregated period, which will be that full retirement phase from 1 January to 30 June. And then from 1 July to the 31st of December, that's going to be unsegregated and have the actuary's tax exempt percentage applied to it. In this scenario, the actuary's tax exempt percentage would be 56% tax exempt. So all the earnings received during that period will have 56% tax exempt applied to it. Now, option two is that the trustees could say, oh, no, we want to use the unsegregated method for the entire financial year, which in this case, the actuary's tax exempt percentage applied for the full financial year would be 76% tax exempt. So having a look at those two options, it really comes down to timing of income and also considering if there's any capital losses incurred, to which options better to go with. So let's say in this example that the member owns a property, and they sell the property on the 15th of January. Now, when they sell the property, let's say that they incur a large capital gain. So if they were to go with option one and keep that deemed segregated period, then the capital gain will be 100% tax exempt under the segregated method. And then any other smaller income received earlier on in the year during the unsegregated period would have 56% tax exempt applied to it. But option two, if they go with that and have the fund unsegregated for the entire financial year, then as the property was, the capital gain was realised during the unsegregated period, it would be 76% tax exempt. So having a look at those two options, you can see that it's clearly better to go with option one and keep that deemed segregated period so that the capital gain realised can be 100% tax exempt under the segregated method.
And Beck, that's the default approach.
Yes.
Am I right? So in essence, what you're saying there is they don't need to do anything in the SMSF annual return if they want to apply option one that you've spoken about in your example. If they wanted to apply option two, there is a requirement to make that choice as part of the SMSF annual return.
Yes, you're exactly right. So yes, I should have clarified that if trustees don't make a choice about which method they want to use, it is going to default to keep those deemed segregated periods.
Yep.
Yeah. And then if they, I should also clarify that if they do make a choice, they'll need to keep a record of the choice they make and the calculation they use. So keeping a copy of the actuarial certificate would be sufficient in keeping a copy of the calculation that they use. So they don't need to write into the ATO and let the ATO know what method they've chosen. They just need to keep a copy of it.
Yep.
Yeah. Okay, well, back to this example, let's say on the flip side that they sold the property and there was a capital loss. Well, with option 1, if we keep the deemed segregated period, any losses incurred from segregated assets have to be disregarded and can't be realised. So they would have to completely disregard the capital loss if they go with option 1. Whereas option 2, if you have the fund unsegregated for the entire financial year, then as a capital loss would be realised off unsegregated assets, the capital loss could be realised and carried forward for future financial years.
And I think that's a really important thing to remember. I know I talk about this a bit now, talking to other professionals as well, that in the current environment, understanding what you might need to do in the future with capital losses becomes really important, because if you think about the context of a mum and dad fund and the fact that one individual, when they pass away, is going to have that superannuation benefit go across to the spouse, in many instances, you're going to end up with an excess transfer balance, which means you're going to have an amount in accumulation. So that if assets then get sold again in the future, that capital loss is actually going to have value attached to it. Now, going back before 2017, that certainly wasn't the case, because all pension phase, it would revert, all pension phase, and then the death benefit would wash out, tax exempt as well. But it's become a lot more important now, in my view, in particular where there's going to be an excess transfer balance in the future, to go, actually, no, that's a capital loss worth preserving. And therefore, looking at that choice here in an unsegregated basis could become critical to the future tax position in that SMSF.
Yes, yeah, you're completely right. Now, back to that example, if we say let's do on the flip side and say that the property was sold during the period where there was a mix of pension and accumulation. So let's say that the property was sold on the 15th of December. If a capital gain was incurred from the sale of that property, well, let's have a look at the options again. So option 1, as I mentioned, the actuary's tax exempt percentage during that unsegregated period of 1 July to the 31st of December, that was 56% tax exempt. So the capital gain would be 56% tax exempt. Whereas option 2 of having the fund unsegregated for the entire financial year, the actuary's tax exempt percentage would be 78% tax exempt. So in that scenario, you'd want to go with option 2 because you'd get the higher actuary's tax exempt percentage. Now, if the sale of the property on the 15th of December incurred a capital loss, it doesn't actually matter whether you go with option 1 or option 2, because the capital loss would have been incurred from unsegregated assets. So you could realise that capital loss in both scenarios.
So how's your head, Miranda?
It's certainly very technical area.
So, Beck, I think the other thing here then on this topic, because it is trying to understand the nuances of how ECPI can be claimed, and I sort of said that in jest, Miranda, but it does become really important to know how these rules can work. And I mean, in that example that you've talked about, you've looked at a scenario whereby there's a hard line drawn at a particular point in time, and subject to which side of the line you're on, you're going to end up with a certain result. Now, there's going to have to be strategic opportunities in there as well. So can I maybe just get you to elaborate a little bit there on, maybe it's that we can create a period, or whether we want to extend a period, and what are the things, I guess, that people should be understanding and therefore exploring as part of the preparation of those 2022 SMSF annual returns?
Yeah, sure. So a common scenario I often see is, referring back to that example, let's say the member received a contribution on the 1st of February. Most people will think like, okay, well, the deemed segregated period, that only went for 1 month from 1 January to the 31st of January, and then it's becoming unsegregated again on the 1st of February. But what trustees can consider doing is immediately commencing a pension with that contribution received on the 1st of February. And that's something that can continue the deemed segregated period right to the end of the financial year. Obviously, they'd need to make sure that they met the minimum pension standards on that additional pension they're commencing, but that's definitely a good strategy if you want to extend a deemed segregated period.
Yep.
Yes, and then obviously just another way is just, if you're able to commence the pension earlier in the financial year, can also create a longer deemed segregated period. Yeah.
Very good.
Yeah.
All right.
Also, I just wanted to mention, probably people listening to this, comparing how I'm talking about the two strategies, thinking, oh, that's all well and great, but I'm not going to know what the actuary's tax exempt percentage is to be able to make this decision. And what I'd say to that is you can download the Act2 Excel form off our website and plug in all the numbers you've got for the financial year, and a draft percentage is automatically calculated from the Excel form. So you could see that to see a draft percentage. But also all our amendments through Act2 Solutions are free of charge. So if you're using BGL Class or Supermate, you can go ahead and request a certificate. And let's say you keep the deemed segregated periods, and then down the track, once you've got the actual certificate back, you think, oh, that wasn't actually the best option. I should have gone with option 2. You can apply for an amendment free of charge, and go with unsegregated for the entire financial year.
And that appears to be the approach that most of the actuaries are now taking. They've spent a small fortune getting to this place, as the software providers have as well. So I guess in that respect, if people are looking to undertake that choice, then what you're saying is we'll go through and in essence request the certificate in one way, also then go through and request the certificate in another way. You won't get charged for 2, you'll get charged for the one.
Yes.
And then from there, work out what the best position is going to be, and that will then form part of the evidence as you then submit the return through the relevant software.
Yeah, you're exactly right. And the actuary providers, we've been talking with the SMSF software providers, and what we're looking at doing is essentially it's all going to remain the same, the process requesting a certificate through Class, BGL and Supermate. There'll just be an option to opt out of the deemed segregated periods if clients wanted to.
Yep, cool.
Yeah, so nice and simple.
There's nothing simple about it, is there, Miranda?
Yeah, I'm not sure that's the word I'd use.
Very
Although
good.
it is good to see that it is going to be made easier through the software and actuarial providers.
Yes. So I think from that point of view, there was a bit of frustration in the industry, I guess, in the shift that the ATO took from 1 July 2017. I sort of tongue-in-cheek made the comment, but it was certainly the case where there was a lot of time, effort and resources that went into those changes. And there is now somewhat a bit of a back to the future, but in the fact that you've got some choice here around which way you may want to go. So maybe they call that a happy medium. I don't know. But Becky, have you got any other final comments? Take the opportunity to do that now. Otherwise, thank you for your time today.
Well, thanks very much for having me.
Excellent. Pleasure. Thank you.
Thank you.
So, Miranda, your head's probably exploding after some of those examples. So I'm going to ask you, what did you get as the key takeaway from that with those ECPI changes?
Well, there's certainly a lot for SMSF professionals to sort of think about, and perhaps some opportunities to do some forward planning as well in terms of getting the best sort of tax outcomes for their clients, especially around the CGT events, and just working out what method's going to be best and when to sort of start pensions and that kind of thing.
Yeah, I think it's going to just have people spend just that little bit more time when you're producing the SMSF annual return to go, actually, do I actually have the ability of choice here? So can I, in the situation for this year, actually have choice, and therefore do I need to make a decision other than what is currently the default that will come through the software as the legislation currently allows for? And that's going to be the most interesting thing, whereby a lot of people just go, let's get it done, and let's get it out the door. Strategically, you've now got to go, actually, is there a qualifying scenario here? And if there is, what is the actual best outcome that needs to be done? So I think there is a big strategic opportunity in here that will require some forward planning from literally now on in with clients, and those that take advantage of it will get some pretty sizable benefits from it as well.
It's definitely a positive, as you said, and lots of planning opportunities.
Yep. So, as is always the case, as we wrap up our SMSF Advisor Show, if people have got any suggestions on topics and or speakers, how can they get in contact with us, Miranda?
So they can get in touch by contacting us at editor@smsfadvisoronline.com.au.
Excellent. Well, thank you once again for joining us for this week's SMSF Advisor Show. We'll see you next time. Bye for now.